This is certainly a time of high geopolitical uncertainty, and none more evident than the war between the U.S. and Israel and Iran. And so we can certainly say this is of relevance to the global economy, and we have somewhat downgraded our growth forecasts on the presumption that some damage should surface. I do hasten to emphasize, though, that this shock, at least unless it were to persist for a very long period of time, is very unlikely to be outright recessionary. And the reality is the global economy is much less oriented towards oil than it was, let's say, 40 or 50 years ago, but also even 10 or 15 years ago. And so there is a degree of resilience that exists, but equally some damage is reasonable to expect. There's a regional variation in that. Certainly Asia and Europe should be more affected than North America to the extent they are the central consumers of the Middle Eastern energy that is now temporarily missing. That North American advantage is tempered a little bit by the fact that we do see some subsidies from governments in Asia and Europe narrowing the gap a little bit, and those economies in fact tend to be just less intensive in their use of fossil fuels, but the bottom line is there is a North American advantage and an Asian and European disadvantage at the end of the day. When we look at the actual data, it is remarkable though how much resilience we can see. And so, for example, the U.S. labor market looking completely normal, no real evidence of damage there. Looking across global developed economies, we can say purchasing manager indices are actually moving higher, not lower. There is actually quite a degree of resilience here. And so again, we're assuming that there will be a little bit of pain later, but it's very much not in evidence right now. The more visible effect certainly is on the inflation side, but that's another story.